Hello guys, can everyone see my screen? Okay, hello. Welcome to our Forex special webinar. I'm gonna be hosting this webinar. My name is Kostas Poliviou and I'm a financial market analyst at IQ Option. Welcome. I'm gonna wait a little bit more for others to join us as well. And can everybody hear my voice clearly? Okay, can everybody see my screen? I'm gonna draw a circle just in case, so you can see it. Let's see. Okay. Okay. All right. All right, guys, welcome. I'm thrilled to have you on board. Today we are going to go through major events that shaped the market during 2018, and we are going to see how various events shaped volatility for major forex currencies. So before we start, some of you might be wondering what's the value of this webinar? Why am I here? Why am I attending this? And what I would like to say is that by studying the past, we can gain insights into the future. We will go through the charts and major events, and we will see how fundamentals and various sentiment events and other events have interplayed together to create the performance we will see together. We are going to go through charts and fundamental analysis, and we will discuss it further. And hopefully at the end we'll have a Q&A session. I think we have time, and I'm gonna be answering your questions. Okay, so let's proceed further. Okay, this is an overview of what are we going to discuss today. First, we are going to see the performance of all major forex pairs. Then we will discuss what happened through the charts and through the lens of fundamental analysis, macro indicators, and various events that happened in the year. And we also discuss sentiment and how this affected the overall picture. And then we are going to see some statistics and end the session with some questions and answers. Okay, so let me go quickly through our disclaimer and also our risk warning. Okay, so I'm gonna switch off the camera so you guys can see me better. Okay, I'm gonna take it out of the way. 1 second. All right. So, all right. Okay. So, what we see in this chart is we have plotted performance of all major pairs compared to the US dollar for the entire year of 2018. As you can see on my screen, as you can see on my screen, all major currency pairs lost value compared to the US dollar, as you can see here, while only the Japanese yen gained value. The Japanese yen posted actually positive performance of 2.8%, while all the rest lost value, with the worst being the Australian dollar. Going to our next slide. Here we can see the same performance, but also compared with the performance in 2000, had positive performance in 2018 versus the dollar, in 2017, sorry, while in 2018 they actually performed worst. So as an example, if someone went long the euro in 2018, he would have gained 14.8% without leverage, while doing the same this last year would have resulted in a loss of 4.7%. Going now to more detailed overview of each pair. We are going to start first with the Euro USD, which is the most popular pair, and you guys trade this the most. As we can see here on the chart, we can see that starting in 2017, there was a strong bullish trend for the euro and dollar. It kept doing higher highs and higher lows all the way up to the start of 2018. And what you can notice here, I have an indicator at the bottom. It's called the MACD indicator, if you are familiar. And what's striking is that while the euro dollar was making higher highs near the end of 2017 and beginning of 2018, the MACD indicator actually made lower highs, which created the so-called divergence. So this would have served as an early warning for bullish traders that there's a high chance that a reversal might be soon, might take place soon. So, and that reversal was confirmed when price, after trading sideways and during the beginning of 2018, it breached below key support level 122 and broke down with force and went all the way to the next support level at 117.5. As you can see here, it made a small sideways move and then broke below this level 2 and went all the way down to 113.5. So after that, for the majority of time, the Euro USD pair traded sideways for the remaining of the year. Now, on the fundamental side and events that shaped the performance of the euro dollar currency, the most important event was the end of quantitative easing. The quantitative easing program started in 2015 and pumped trillions of euros into the European economy. And the Central Bank of Europe announced in June 2018 that it will end this program by December end. But as you can see, price and investors and the market overall anticipated this move, and price corrected well before the announcement. Now, going on the fundamentals, what we can see here is that the Central Bank of Europe left the key rate flat at 0% to boost the economy, especially now that the quantitative easing program ended. GDP growth slowed a bit to 1.6%, down from 2.7 during mid-year. Inflation followed a similar path. When in mid-year 2.2, but slowed down to 1.6 during the end of the year, while unemployment actually improved and it fell from 8% down to 7.9%. Overall, the European economy grew, posted healthy growth, but it was just enough for the European Central Bank to stop the quantitative easing program, and not enough to raise interest rates. As we can see here, overall the pair make from high to low in 2018 traveled 1,325 pips. And this is the overall picture for the euro. And now we're going to see the US dollar side of this pair. In our next slide, we can see the chart is the same, of course. And here we have different events and fundamentals that shape the value of the dollar. As we saw earlier in the chart, the US dollar has been the best performer for 2018. And this was supported by both strong fundamentals and by both events and trader sentiment. The most important event has been, of course, the US-China trade wars that where basically US posed enormous amounts of tariffs on Chinese imports, and China responded in similar kind, but more like half in terms of amount. And this only helped the dollar grow stronger because the uncertainty surrounding these trade wars created the need for safe havens assets like gold, the Japanese yen, which we saw was the best performing currency, and also demand for the US dollar. So on top of that, we had a very strong economy. The US economy was very strong. We can see here the major economic indicators posted very good results. We have first annual GDP growth at 3%. We have unemployment rate near historic lows at 3.7% and 3.9%. Meanwhile, NFPs or non-farm payrolls, as you may know them, beat expectations and posted very strong results at 312K. December inflation came in at 1.9%, matching expectations. And while the average inflation was actually higher for the entire year. And this prompted the Fed to raise interest rates up to 4 times during the year. So we have these 2 factors. One is uncertainty from trade wars, and from the other side, we have strong fundamentals from the US economy. And we saw that all these played a role in strengthening the US dollar and actually causing the US dollar pair to move downsides. We have the weakness from the euro versus the US dollar. So the pair, as we have seen, have traveled more than 1,000 pips. And now, next, we are going to focus on the British pound. British pound had a volatile year. Brexit and Brexit developments dominated headlines for the majority of investors and traders. Many investors disregarded fundamental developments and only focused on Brexit. As we can see here, the currency pair traveled 1,893 pips from high to low. And while in 2018, the pair started relatively higher, near resistance level at 143.5, we see then that it collapsed downwards and it broke below the next support level, and then subsequently broke downwards, even lower at 127. So what dominated this the move was the risk aversion from traders. Traders were afraid of holding the British pound because of high risk and Brexit-related risks, and so they opt to short it instead of buying it. Meanwhile, on the fundamental side, we had GDP growth at 1.5% in Q3. Unemployment was still near historical lows at 4.1%. November inflation stood at 2.3%, lower than mid-year, but still above the central bank target. And one could say, okay, if inflation was above 2.3%, above the 2%, why did Bank of England raise only once interest rates? And that actually happened because the Bank of England is still concerned about the Brexit risks and preferred to raise interest only once and leave them at historical lows in order to safeguard the economy. All right, so next in our list is the Japanese yen versus the US dollar. As we can see from the chart, throughout the year, basically the USD Japanese yen trade within a larger range. Initially, the pair started here, below actually a resistance line 114, and then went to collapse. It broke below every support level, reaching an all-time low near the support level 105, and then completely reverse course, breaking previous support, now resistance levels here and here, all the way up to 114.20. Then it traded sideways and then collapsed again. But as we have seen, the Japanese yen has been actually the only currency that fared better when compared to the US dollar. And there was only one major reason for that. And as we have seen for the US dollar, they have a shared reason for that, is that the increased global uncertainty about geopolitical events, about sanctions, and about Brexit made investors move towards safer assets like the Japanese yen, the US dollar, and gold. And this was reflected in the performance of the Japanese yen. However, the performance of the Japanese economy has not been strong enough to justify this. we saw that annual GDP growth stagnated in Q3 with zero growth, 0%. Unemployment rose to 2.5%, but still was relatively healthy. Inflation softened in November at 0.8%. And all this together prompted the Bank of Japan to keep interest rates unchanged at minus 0.1% in order to offset the risk of deflation. So as we can see here, the performance of the Japanese economy was not the driver behind the Japanese yen strength, but rather it was more investor sentiment and risk-averse strategy and initiative. So with no further delay, let's go to our next chart, the Canadian dollar. As we can see, the Canadian dollar actually is one that behaves a little bit different than other currencies. As we can see here, price in 2018 moved within a channel, within a bullish channel. And one characteristic of bullish channel is that price does not exactly respect key support and resistance levels. It breaks through, makes a higher high, but then it makes deep pullbacks, and then proceeds to go even higher. But it's slightly higher each time, and we have slightly higher highs and slightly higher lows, which is an indication of a channel. Overall, the Canadian dollar weakened too versus the US dollar. On the fundamental side, we had GDP growth at 2.1%, which was above the central bank target. Inflation slowed at 1.7% in November, down from 3% during the year. Unemployment rate stayed at historical lows of 5.6%. And Bank of Canada raised interest rates twice, reaching the level of 1.75. So overall, we had a moderately growing Canadian economy, but still, if we compare it to the fundamentals of the US economy, the Canadian economy was relatively weaker. And this resulted in the Canadian losing value compared to the US dollar. Now, on the Australian dollar, as we can see, there was a very volatile year for the Australian dollar. There were mostly one reason why the Australian dollar had this rapid weakening. As we can see here at the start of the year, Australian dollar started strong the year, but then it lingered over support line 0.78 and then broke it decisively, then retested it and then went even lower with force, only to correct a bit and then broke again lower levels, lower support, and then again, and it went towards the end, beginning of 2019, it reached even low as 0.675. So what happened? First and foremost, it was risk aversion from all investors that consider Australian dollar to be riskier than other major currencies like the US dollar and the Japanese yen. Meanwhile, the Australian economy is dependent on exports and on commodity exports, and the value of the Australian dollar is highly correlated with the prices of these commodities. And one major commodity is iron ore that also showed weakness during the year and affected price of the US dollar even further. Now, on the fundamental side, we can see that GDP growth was at 2.8, slightly below expectations of 3.3 in Q3. Inflation stood at 1.9, in line with expectations, while unemployment just slightly went from 5% to 5.1. Meanwhile, the Reserve Bank of Australia left interest rates unchanged in order to mitigate the risk from falling commodity prices and the risk aversion from investors and traders around the world. In a similar fashion, we can see here the New Zealand dollar. For some reason, the New Zealand dollar exhibited price action very similar to the Australian dollar. It started the year on a strong level and then traded sideways above key support level 0.719 and then collapsed and broke that support level, went to the next one, rebounded a bit, and then broke that level too, and subsequently broke the next level. So it reached an all-time low of 0.64 during the year, and then reversed course only to retest previous support, now resistance line at 0.69.5, only to collapse again. So again here we had a similar theme like the Australian dollar. The performance of the New Zealand dollar, or Kiwi as it's called, was mainly affected by risk aversion impact. So it was not fundamentals that determined the performance of the Kiwi, but rather it was sentiment and risk avoidance. So on the fundamental side, we had annual GDP growth falling at 2.6 in Q3. Inflation rose to 1.9% in Q3, while we had a record low of unemployment at 3.9%. Meanwhile, the Central Bank of New Zealand have left interest rates unchanged purposely at 1.75 in order to maintain growth in the New Zealand economy and avoid risk of inflation weakening. The central bank has a target of 2% plus or minus 1%, and inflation just touched the lower end. So the bank opted to leave the rates unchanged in order to secure its target. Going to our next currency pair, Swiss franc. As we can see here, Swiss franc also weakened against the US dollar. Initially, the pair started the year on a strong foot, but then it weakened. It broke above resistance level at 0.955, and then it went directly up to the next resistance level, breaking this again, consolidating a bit and ranging sideways, as you can see here, then coming down again, breaking previous resistance, now support line, to retest the level of 0.955, and then again went up all the way to the high resistance level of 1.0075. So initially after starting the year and breaking the first support level, USD CHF mostly traded in a large range, as we can see here. What dominated this performance was more like fundamentals instead of sentiment for this currency. Despite having GDP growth of 2.4 in Q3, inflation was very weak at 0.7% in December, missing expectation and being well below the central bank target. Meanwhile, unemployment rose slightly, and the central bank left key interest rate unchanged at minus 0.75%. And the reason for this obviously is because the economy needs more momentum in order to bring inflation to more sustainable levels. And this was reflected again on the price. We see here it started stronger because the Swiss franc is on the lower side of the pair and went up and stayed weak for the most part of the year. So next we have some statistics. We have average daily volatility for each pair for 2018, and we can see here that the most volatile pair has been the British pound versus the US dollar, while the least volatile pair has been the New Zealand dollar. So one can ask, okay, what's the usefulness of knowing a statistic? As we can see on the next one, on the next slide, we can see that the British pound is consistently the most volatile pair, while the New Zealand versus the dollar is consistently one of the least volatile ones. So having this information in mind, that aggressive traders might opt for the most volatile ones, that means these pairs will most likely make large moves, large swings, either up or down. And so it are more suitable for aggressive traders that want volatility, while the least volatile currency pairs are suitable for more conservative traders that want less risk, less volatility. And as we can see here, the three most volatile pairs has been the British pound, the Euro USD, and the USD CAD. Meanwhile, the most volatile has been British pound, Euro USD, and USD CAD, but the ones that showed increased volatility has been British pound, Euro USD, and USD CAD. So, guys, I think this is our presentation for today's webinar. I'm gonna switch back on the camera, and I'm gonna receive your questions, and I will be happy to answer any questions you might have in regards. Let me switch off the camera, and I'm gonna check questions. You can write on chat, and I will be reading them. Okay, so any questions? There is the option you can send me on chat or privately as well, using the dashboard button. Okay, I have one question here, if I understand correctly, is why is it happening that on fundamental events, economic news releases, I guess, we have price is not behaving as expected? Okay, if I understand correctly, is that when we have economic releases, we have positive surprises, like non-farm payrolls coming stronger than forecast or previous results. Why does the US dollar not appreciate? Okay, so it's a good question, and let me throw a thing. Okay, let me throw. Let's take an example. Okay, let's use an example. Okay. So let's say we have non-farm payrolls coming out together with unemployment rate. Okay, so we have NFPs, and we have at the same day, simultaneously, we have unemployment rate for the US dollar. Okay, so let's say that NFPs come at 340K, which is better, the higher the better. Previous forecast, sorry, was 320, and previous one was even lower, 310. Okay, this is 1000K. So we have what we have in this scenario. We have actual results being better than forecast, okay, and than previous. So we have a positive surprise. Meanwhile, on the unemployment rate, we have, let's say it comes out at 3%. Okay. Then the forecast was actually for 2.8, lower is better, sorry. Okay. But the previous one was actually 4%, even worse. Okay. So what do we have here? We have unemployment missing expectations. It came worse. Higher is worse for unemployment, which is bad for the dollar. So we missed the forecast. But we have NFPs that beat forecast. So we have conflicting economic news releases. So it's natural in these times that the market takes some time to digest the information. Okay, because although 3% unemployment is better than 4% the previous one, which means that most likely the US dollar will appreciate. NFPs higher mean that most likely the US dollar will appreciate. The market is confused on initially by missing expectations. So the market needs some time to digest all this information. And what usually happens is that it will take the most likely course a few hours later after the release. Okay, I hope this helps. Let me see your questions. Okay. I have here a question, I think. No, it's a comment. Okay, so, okay, guys, any questions? I'll be happy to ask. Let me clean this up. I'm gonna remove drawings. Okay. So going through your comments, guys, I don't see any questions so far, other than the first one. Okay. Okay, I see guys raising hands. Can you write the question on the chat? It's gonna be easier than giving you access to audio. If possible, please write on the chat. I'm gonna write. All right. If you can see, you can see the chat box. Please write your questions in the chat, please. Do not send me privately because it's harder for me to read. And okay. So I see hands raised. Let me check. Okay. All right, guys. I think we have no more questions other than the first one. Okay. I think we are going to wrap this up. I'm happy you join us. Excited to see you here. I hope this webinar has been of value to you, and we look for your feedback and see you joining the next ones. I think tomorrow is money management, and afterwards is the webinar of CFDs, where we are going to cover commodities and cryptos and stocks as well. So I hope I will see you there. Happy trading. Cheers.